you've been writing about the mortgage market meltdown. Where are we right now? How did we get here? What's going on?
Well, we're kind of still in the chaotic stage right now. When March 9th came in and the 10-year yield got down to about 32 basis points and mortgage rates fell with it, the first thing that came to my mind is early payoff risk, which means that refinances would accelerate. It would cost the industry a lot of money because, if you're providing, a good example is if you're giving $10,000 to give somebody an interest rate, you need to keep that loan on the books for at least 18 months to break even or make money. And basically all the loans in 2019 and even 2020 were at risk of having an early payoff. And that, is a financial burden. Then, the mortgage rates were moving so much that you had margin call risk. And these are things that aren't really familiar to the general public. So you had two hits right now on the mortgage side of the equation. And then, as always, whenever a recession is here, and as March 12th, you can see that was the last day we had good jobless claims data. So credit tightens up as well. So you're getting hit on multiple sides. And just to add another layer, the fourth one is that the servicers are going to be at risk because of the forbearance. The forbearance was open to the public in general, and they don't really have enough capital to take that much payment that they have to give to the bondholders on top of that. So you have four significant factors all coming into the mortgage market in a matter of weeks. And this is why we see this credit stress. This is why mortgage rates went up. That first week of March 9th, rates actually went up 1% those 5 days. So there's just a lot of stress right now in the mortgage market. And some of these things are going to be with us even if the economy recovers in Q4 and people go out and, can walk the earth again. I still think the credit tightening is going to be here for a while.
Yeah, that you paint a kind of bleak picture. So let's walk through those one at a time and just explain a little bit about what the context is and why it matters so much.
Well, first of all, the non-QM side. Non-QM loans are basically loans that aren't guaranteed by the government. So they're a little bit out of the box. Now, they're nothing like what we saw during the housing bubble. These aren't 80-10-10 option arm loans that are going to recast on you and create a foreclosure. These are just a little bit out of the box in terms of bank statement loans. Those kind of things, especially in the jumbo market, are gone for the most part. It's very little. I think that market gets hit. FHA lending, which, below 620, which isn't that big either. The credit standards have gone up. So that market for a short time is gone. So that's where the credit tightening, which would happen in every situation when you're going to a recession. So I estimate about 4.
Logan, just real quick, for context, what's the percentage of total loans that are non-QM?
I would say that this is actually what I was just about to say, 3.7 to 4.3%, roughly. That's basically the non-QM loan. So it isn't a significant portion of the mortgage market, and they're really some of these buyers are actually very well qualified. They just don't show income. They have to do bank statements. Some of these are what I call kind of a rich man's loan, but that's gone. So that portion of the demand is going to be out for a while. So you're looking still, at a 6 million total home sale market. You're looking at a couple 100,000 homes that just aren't going to be back until credit gets better and Wall Street wants to come in and support some of these markets. So that aspect is out of here. And that no matter what happens with the economy, until you see credit get better, this part of the housing sector just won't come back quickly.
It's interesting. You're talking about a percentage of the market that's less than 5%. But when things like this happen, there's these sort of swings at the margin. Does that have a potential impact to have a more significant impact on general price levels in the housing market?
Well, here's the interesting aspect. The first 2 months of the year, not only the economic data was better, housing for the first time in this cycle was breaking out. So much that if we didn't have the virus, I would be writing about home price growth 8% year over year on a nominal basis is way too hot at this stage of the cycle. Typically, housing gets softer when the 10-year yield is above 2.62%, which is roughly 4.5% mortgage rates higher. This is a little bit different. Housing has accelerated the first 2 months of the year. 13-year highs in existing home sales. Inventory is down year over year to the lowest level. So this notion that there's no homes to buy, twice in this cycle highs in demand with inventory at cycle lows. So the housing market was doing really well. But what we see now is this is not like a typical recession where demand just basically fell off because the economy itself. People aren't going out and looking at homes. People aren't having traditional open houses. So just like all economic data, purchase application data has the ability to drop 54% plus on a year-over-year average. The first 8 weeks, really, of the heat months I've talked about for many years, it's the second week of January to the first week of May. We had double-digit year-over-year growth every week up until March 18th. That was the last one. So the last 2 weeks, we saw negative 11% year-over-year and negative 24% year-over-year. That's not because demand has just simply fallen off and the homes are too expensive. It's just simply people aren't going out and buying homes at this time. So the next 90 days, we have to look at housing data with a little bit of a grain of salt, because I think sometimes we might get overly too bearish and inventory levels are just going to skyrocket. Delistings have fallen off. I think Redfin had an interesting data line where 148% year over year delisting, because some of these sellers are just going to, hey, listen, I'm just going to wait till this lockdown is over before to sell my house. Where in 2006, monthly supply was already above 6 months. Home sales were falling noticeably in 2006 on a year-over-year average. We were also working from a very extreme level. Here, it's not that case. So it's going to be a little bit tricky looking at housing data for the next 90 days.
To what extent is this market regionalized? And do we see major differences, or is this something that because there's a systemic transmission mechanism, we're seeing some level of homogeneity across the country?
It's basically California, New York, and then everything else is different. Whenever the 10-year yield increases in 2013 to 2014, we saw that happen in 2018 and 2019. It's the coastal areas that get hit. Pretty much everywhere else is the same. It's not like we ever had a crash in demand in this in this cycle for housing, but you definitely see that the coastal areas that are tied to mortgages, when mortgage rates get to even 4.5 or 4.625, even though on a historical basis it seems very low, those sectors get hit. Now, obviously, it's not the case now. Mortgage rates are lower, but it's always the coastal areas, Seattle, Los Angeles, San Francisco, San Diego, New York, that get hit. And that's because higher mortgage rates. And I think everywhere else is okay. We've seen that in the data, but also new home sales. New home sales, to me, is the area that gets impacted. And it's the most crucial area in terms of housing to GDP, because it's construction jobs, it's housing starts. What we saw in 2018 when mortgage rates got to 5% is that we saw a spike, a recessionary spike in monthly supply of new homes. And that basically meant 2019 total housing starts were flat, even though historically they were still low. That is the area to always look at, because that's the most important area for housing for the economy. And higher mortgage rates have impacted new home sales always. But again, even new home sales were accelerating the first 2 months of 2020. So we have to be mindful that what happens in the next 90 days might not happen when people are able to go out and kind of walk the earth, because demographics for housing is the best right now. A lot of my work is that this housing cycle from 2008 to 2019 would be the weakest ever recorded in history, because demographics were more favored for renting. Years 2020 to 2024, ages 26 to 32 are the biggest in U.S. history. Your first-time homebuyer age is 33. So the existing home sale market should do fine, but we should always be mindful of the new home sale market, because that is prone to drastic hits when mortgage rates are higher, because it's a very small marketplace competing against this massive existing home sale market that are cheaper homes, geographically spread out all over. So the new home sale, to me, was always something we have to be mindful of for the next 5, 10, 15, 20 years, because it's at a disadvantage versus the existing home sale market.
So Logan, 2 questions. So first of all, what's the total proportion of new home sales on a number of sales basis and also on a dollar basis relative to existing home sales? And second, what's the macroeconomic outlook for new home sales going forward in terms of construction?
The best way for me to showcase this is that the existing home sales market, the last data line was showing at 5.77 million. And the new home sales market, the last sales was 765,000. Now, there's always a 1 to 6 model, new home sales versus the existing home sales market. But one of the reasons why new home sales have really underperformed for many years is that this is a much more expensive home. And we've been building bigger and bigger homes really since 1975. But when mortgage rates started to really perk down lower, 1996, if you look at the median square foot of a single family home, we're at 2,000. We got as high as 2,700 during this the previous expansion.
These are when you look
at square feet. So median square feet. But if you look at the size of families, they've been falling. So we've been building bigger and bigger homes for the new home sales market while family sizes have gotten smaller. So you can see the advantage, the existing home sales market, which, if you look at housing in general, it's a $30 trillion industry. That sector always has an advantage over the new home sales sector. So going out for many decades, now the builders have gotten the memo after 2014. I think 2014, when they had this big sales miss, people were looking for 20% sales growth that year. We barely finished positive, working from a very extreme bar. They're trying to provide smaller homes. And I just think it's going to be difficult for them going out for decades because they're always competing against a massive existing home sales market. So whenever you hear economists over the last few years always talk about, well, we have to produce more homes, the key is that the builders never purposely oversupply the market. They're basically always keeping in line to their supply and demand models and their profit margins. So you're never going to see an oversupplied new home sales market unless the government comes in and basically, starts building on their own. So I think that's the thing going out for many decades is that the new home sales market is always going to be at a disadvantage. Every decade that we progress on, there's just more and more existing home sales or existing homes out there. So it's difficult for the builders because that's their main competition, right? And we're not talking about, we produced almost 2 million housing starts in the last cycle. So there's homes out there that are just cheaper, smaller, and there's more of them in any city. And I think that's the difficult part that the builders have to work with. Because new home sales have had this weakest cycle ever recorded in history, they're just working off a lower bar. That's the advantage the new home sales market has over the existing home sales market is that, underperforming for many years, you just have a low bar to work with.
Another thing that you watch very closely and that you do a lot of charting on is employment and employment cycle related information. So what's the potential impact or the feed through of a decline in new home constructions? What's the outlook look like? And what does it portend more globally from a macroeconomic context?
Well, a lack of production definitely means construction jobs go down, big ticket items go down. Now, on a historical basis, when you have an overheating housing market or housing starts above 1.5 million, you're always at risk of production coming down. But except now we're kind of we've never oversupplied the market. We're kind of under production. So if this recession is a few quarters, you'll see a production cut maybe for just a few months, and then we just go back to trend because we're not working from any. If you actually adjust it to population, housing starts are still very low. They're not that much higher than what we see after a recession. So housing, because it's underperformed this cycle, won't get hit as hard as, let's say, the car market. We've had, the best 5-year car sales, and now we see 43% decline year over year. The car sale is more at risk than something like in the housing market because new home sales and total housing starts are still relatively low versus the population.